Welcome to today's webinar, Fund Structuring Across the EU, Why My Jurisdiction is Better Than Yours. This event is organized by the European American Chamber of Commerce, where Europeans and Americans connect to do business. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC in New York, and I will be your host for today's event. About today's program, our discussion will bring together panelists from different EU jurisdictions, Ireland, Italy, and Benelux, who, under the moderation of Troutman Pepper partner and fund expert Greg Novak, will make the case for their jurisdiction in a very friendly competition with each other by comparing the pros and cons to convince the audience why their country is more attractive to invest for US fund managers. Our speakers include Luc Courtois, a partner at Nauta Dutel and head of the Luxembourg Investment Fund practice. Luc has more than 25 years experience in the Luxembourg legal market and specializes in setting up UCITS and other regulated funds. And Conor Durkin, he's a partner at Mason Hayes Curran in Ireland and heads the firm's financial services team. He specializes in investment fund and asset management and advises leading international asset managers on carrying on business in Ireland and specifically on establishing and structuring all kind of collective investment schemes. We also have Barbara Sanzisi of Legance. She is based in Italy, and Barbara is a partner at the investment funds department of the firm and has solid corporate and M&A background. She advises private equity and alternative asset fund managers and institutional investors. Our moderator will be Greg Novak. He's a partner at Troutman Pepper in the Philadelphia office and a frequent visitor in New York, and the practice leader for hedge funds at the firm's private fund service practice group. He concentrates his practice in security law, particularly in representing investment management companies. And Greg represents many hedge funds and other alternative investment funds in fund formation, investment, and compliance matters. And with that, I hand over to you, Greg. Thank you.
Well, thank you, Yvonne, and thank you for that very generous introduction to all of our panelists and to myself. And I'd like to welcome all of you to our virtual roundtable. Had this been a different time, we probably would be sitting around with some cocktails and enjoying each other's company in person. Hopefully we will be back to that once this vaccine or one of the vaccines becomes efficacious and distributed, and all of us are once again back to our normal lives. Although I will have to tell you, I will miss the 30-second commute from my upstairs to my office in my house. But in any event, thank you again for your attention, and I would like to welcome our panelists, a very distinguished lot they are. Our topic today is, as Yvonne pointed out, my jurisdiction is better than yours. And in order to tee up that issue, we're going to talk about 3 transnational situations. And if you're following along with the slides, we're on slide number 2. Essentially, the 3 scenarios are as follows. Foreign investors, in this case EU-based, since all of our experts are from the EU, in the United States, either through a US venture capital, private equity, hedge, or even indirectly publicly traded securities. The second scenario, US investment managers seeking to invest US client money, it could be from a private fund or separately managed accounts, into EU-based portfolio company investment opportunities. And finally, US investment managers seeking to sell US managed product into the EU for investment by EU residents. And the idea here is global money is, in fact, very liquid and very easily moved from jurisdiction to jurisdiction, assuming that AML and KYC rules are followed. Having said that, however, the opportunity has to be easily identified. It has to be transparent. And the ability of the investor to realize on his investment has to be understood. And there has to be a path forward, meaning there has to be the rule of law. Those rules from jurisdiction to jurisdiction tend to be very complicated. In fact, one of our slides, you'll see that foreign investors tend to look at the US as a morass of law that no one really understands. Well, that's why you have somebody like me to be your Sherpa as we walk through the US laws applicable to investments on a transnational basis. So if we want to flip to the next slide, I'm going to focus on the issues that are present in the United States for foreign investors. So a very important thing to consider when you are going to make an investment in the US, whether it is into a US portfolio company or into a fund, is you need a framework for analysis. Who is making the investment? Is it a natural person, an entity, or a fund? Why is that important? Well, if it's a natural person, you must worry about things like inheritance tax imposed by individual states or the federal gift and estate tax. Not quite as much an issue because of the current deductibles, which are about $11 million, and those are due to extend through 2026 unless the Biden-elect administration changes those. But as we are standing now, if it's an entity or a fund, there are different rules that are applicable, and we're going to get into those in a moment. The other important consideration is the nature of the investment. Is it an investment in debt or equity? If it's debt, then it has to be able to qualify for the so-called portfolio interest repeal, because otherwise there would be a withholding tax on the interest payments. If it's equity, there may be a withholding tax on dividends, but not on capital gains. So growth stocks tend to be favored than stocks of large cap value companies. Why? Because they pay dividends, and dividends, unless there's a treaty that eliminates them, tends to be subject to withholding tax. Is the issuer a corporation, an LLC, a partnership, or a trust? Well, why does that matter? Well, in the US, a corporation pays dividends. Dividends are subject to withholding tax. An LLC or partnership, on the other hand, if it's engaged in a trade or business, will actually, by statute, draw the investor into the US, and you will now have effectively connected income. And those of you who do international investing know that if you're going to step into a jurisdiction and be subject to their domestic tax laws, there has to be a very good reason to do that. Trust can go either way, and it depends on how it's set up. So, for example, a securitization trust that's used to take the combined debt instruments of car buyers or car lessors, and you're going to invest in a securitization trust interest, may very well not give you UBTI, or I'm sorry, ECI rather, effectively connected income, but it will nevertheless require you to do some due diligence to understand exactly the nature of the instrument you're buying. And then, of course, you have digital assets. Well, you know, the interesting thing is your money in your bank account now is digital. No one actually has a vault filled with stacks of currency or hard metals or whatever it may be, except central banks these days. And so your assets today, whether they're in euros or dollars, are in fact digital. But when you go to other digital assets, such as Bitcoin, which is generally considered a currency across most countries, and in the US is considered to be a commodity, not a currency, excuse me, or other digital assets, well, those other digital assets are likely to be considered securities after some recent court decisions and enforcement actions by the SEC. So just because in your country a digital asset might be viewed as a currency, you must understand that if its source of organization is in the US, there very well may be a US domestic securities law implications to your holding of that digital asset. That talks about the nature of the investment and what it throws off. Who's arranging the sale? Is it the issuer, or a secondary market purchase, or a broker? And if you're using a broker, is that broker registered with FINRA, the Financial Industry Regulatory Authority, or are they claiming to be a so-called finder? In the United States, finders have a long and storied history, mainly of being pushed down by the SEC and transactions in which finders are involved being disabused by the issuer because they were illegal. So if someone wants a finder's fee, you need to understand the regulatory morass associated with that. And the reason why this is important is if it turns out that an illegal finder was used, the issuer or the seller has effectively given the buyer a regulatory put under US law, meaning that the buyer can say, I want rescission, I want my money back. And so the use of a finder in US, under US law, where there's US jurisdiction, is a very, very, very sketchy proposition. Now, there were some recent proposals from the SEC to formalize certain finder relationships. But they are still proposals, and you may not rely on those because they're not law. So you need to understand how you are acquiring this asset. Is it a secondary market purchase? And if so, have restrictions on the sale of that security lapsed? Under the US law, if the security is issued by the issuer in a private non-registered transaction, it may not be sold for 12 months unless an exception applies. And these are things you may have heard the term big boy letter. Well, essentially that is a letter from a law firm knowledgeable about the facts and the law that gives an opinion that says an exception applies, and therefore the issuer does not have to worry about being considered an underwriter. Because if the issuer were deemed to be an underwriter, or any other person for that matter, and they're not licensed as an underwriter, then that raises the rescission right. So in all of these instances, there's a path. You have to follow the path. If you deviate off the path, the likelihood is that you've created a circumstance where the investor can get his money back. All of this is about allegedly investor protection. And so you need to understand those rules in order to protect yourself. And then finally, we've alluded to them a little bit. What are the tax consequences of this investment that you're making in the US? What are the natural withholding taxes that are applicable? The portfolio interest repeal, which came in during the Reagan administration, is essentially a change to domestic law, meaning there is no withholding tax on instruments that meet the requirements for certain bank accounts or other debt instruments issued by domestic issuers. However, there are withholding taxes on dividends, and that's usually 30%. It's called FDAP, fixed determinable annual and periodical income. Now, I'm not going to get into the intricacies of this, leave that to the tax lawyers and accountants. But as securities lawyers and investors, we at least need to issue spot and understand what the issue is. And from the point of the securities lawyer who advises funds, I need to be able to disclose it so that you as investors who then take our private placement memorandum or other registration statement at least have a semblance of the issues that they're going to be faced, the material issues, so that you can then resolve them and decide on your own whether or not this is an appropriate investment. The availability of a treaty. Now, this is a big issue because of the base erosion provisions that have been adopted by most major trading partners in the world. And effectively what that means is you can't create an entity in a member state in a treaty just to get the benefit of that treaty if you have no other connection to that country. And the base erosion provisions are of particular interest when we're talking about some of the structures, and we're going to get into those with Connor, Barbara, and Luke as we discuss their countries and whether or not the access to the treaty network is real or ephemeral. And then finally, in the United States, you cannot avoid that there is a wealth transfer tax called the estate tax at the federal level. The gift tax is essentially designed to prevent people on their deathbed giving away assets and avoiding the estate tax. And so it's a combined unified tax structure on transfers of wealth. And then the states, given the fact that we are a federal system with two different governments overlaid on each other, the states have and impose their own inheritance taxes. Now, for many, many, many years, the state inheritance tax was a credit against the federal estate tax due, and that's still the case. However, because the federal estate tax deductibles are so high before the tax kicks in, the likelihood is that if you're a natural person and you have connections to the US, like an apartment in New York City or a mountain home out in Montana, it's likely that, and assuming those states impose these taxes, you might be subject to the inheritance tax in those states if you meet the residency requirements of those states. So the point is, these are not for the faint of heart. If you're going to make an investment, you need to understand what the implications are, which is why many investors choose to come through the Cayman Islands through a feeder fund. And why is that? Or not just the Cayman Islands, but Bahamas or the British Virgin Islands or any of the other so-called havens in the Caribbean. And why is that? Well, because the entity itself acts as a blocker. And since there are no natural persons, it's very hard for an inheritance tax or an estate or gift tax to attach to a non-natural person. So, having said all of that, you understand when you are coming into the United States from a foreign jurisdiction, there's a whole panoply of rules: corporate rules, trust rules, fiduciary law, tax rules, as well as just making sure you get the benefit of your bargain. The one good thing is, if you are in an investment in the United States, the legal structure is fairly well developed. And if you have a claim, you're going to have the ability to get redress in some way or other, assuming that the US court has jurisdiction over the assets and they haven't been hidden or otherwise spirited away from the jurisdiction. And so understanding where the assets are custodied, who the custodians are, whether they're subject to US jurisdiction, all of these are very, very, very important considerations as you decide to make a foray into an investment in the United States. So before we go to the outward investments, where we're going to be investing in our European jurisdictions, I'd like to open up the floor to my colleagues, and perhaps you could give us any of your insights of what you see when you are advising your clients about making investments in the US market. So let's start with you, Barbara. From the Italian perspective, you have an Italian investor who wants to invest in the US. What do you do?
I think probably the first issue will become for us let's say the regulatory one. So probably it is important to state at the beginning that there are no passport that is granted to non-EU manager under the AIFMD to non-EU AFM. That means, and this is probably the most critical issue, that you have this market, the Italian market, is not accessible to non-EU AFM. So how to deal with, how to assess and how to have an Italian investor investing in the US? I think the alternative solutions are potentially two. The first one is having the non-EU AFM to rely on an EU AFM, so having, a Luxembourg-based or any other headquarter in Europe that would consent the AFM to benefit from the AFMD, or, and this is probably the easiest way, to rely on a reverse solicitation basis. So to have the investors, the Italian investors coming into the US fund through a reverse solicitation. That means that the investor, by its own initiatives, has to contact the manager and has to ask for a potential investment in the fund.
And how about you, Luke? What about coming out of Luxembourg into the US?
Well, hello, hi everybody. We have been in Europe, actually, we have the same issue than Italy and Ireland, but there is also a provision in the IFM directive, which is the private placement possibility, actually, so that would be feasible for a US manager actually to market in Luxembourg an American fund, I would say, or a Cayman fund, or a non-EU IF. So that would be marketing without the passport, but you could do it actually. But that's the point, it's not limited normally to professional investors. So you would be able to approach those professional investors. But again, it depends upon the country. In Luxembourg, for instance, we have also put in the law the possibility to extend that passport, not passport, but to extend it to retail investors under certain conditions.
So but hold on a second. No, I'm focused on, let's say you have a Luxembourg resident who wants to invest in Apple on the US stock exchange. So they're coming into the US as opposed to a US manager attempting to attract assets abroad. When you have that structure, are there any considerations in particular in Luxembourg that you're looking at as you advise clients who want to make investments in US portfolio companies or US activities?
Well, no, actually, it's more a question for US lawyers to put the right structure in place. It's not really for Luxembourg. If you are referring to local investors wishing to invest in the New York Stock Exchange or other markets, it's more for US lawyers to structure the investment. What we see maybe is we put investors into feeder funds, which is something really usual in the market. So we put the US the EU investors into a Lux feeder fund, and that feeder fund is investing in a US master. That's the way also to structure it. Basically, that's more for US lawyers actually to set up the structure in the US.
So Connor, we're actually flipping to the third point of our outline, which is U.S. fund managers trying to gather assets in the EU for their funds. And let's talk about the structure that would be put in place in Ireland to facilitate that. So again, let's go back to our fact pattern. We have a U.S. fund managed by a U.S. advisor, and they want to attract foreign investors into the fund. How does Ireland deal with that issue?
In that context, we're talking about an Irish problem and a European problem. And it's broadly European because of the harmonized legal framework that we have in Europe. So for US managers looking to tap into Europe for the purposes of capital raising, they have broadly three mechanisms in terms of which they can access the European markets. The first, which is preferable from an Irish perspective or European capital raising perspective, is to set up a European fund with a European manager. And we can talk about that in a second, but that brings its own cost and complexity. A second route into the market, which might be more relevant for US managers if they're looking to raise capital in certain markets only, and they're not necessarily needing to rely on a full passport, would be what we refer to as marketing without a passport. This is sometimes referred to as private placement. Effectively, we're registering the US fund, be it a 1940 Act, or be it a Delaware fund or US private fund, or possibly even a Cayman fund, and availing of the private placement regime in Europe. And the third, which is sometimes referred to as reverse solicitation, which really isn't a marketing regime at all. It's actually dependent upon investors coming to the US manager at their own initiative, which is not really a sustainable marketing strategy. So I'm going to pause there maybe and let you ask me some questions maybe in relation to what the system is and what the regime is for setting up a European fund, because that really is the gold standard.
So let's go back to your last point about reverse solicitation. You're saying it's not really a strategy. Obviously, if a EU investor hears about and finds out information about a US fund and chooses to make that investment, has the US manager tripped any statutes or rules in the EU? I'll ask you, Luke, if the US manager has an open website, for example, and someone is searching for that particular investing style, does that open website constitute a violation of the law in Luxembourg or in the EU, as you're aware, where that foreign investor now uses the information that's generally available to make that investment? And the reason I'm teeing it up in that way, in the US, an open website is deemed to be a general solicitation. And unless you either have a registered security or you do what's called a 506c offering, that open website is essentially a holding out or an invitation for all comers, and therefore would be a violation of the private placement rules. So, Luke?
Yeah, well, that's a good question, because it depends actually, as Connor said, whether it's really coming from the initiative of the person. So you should really put a disclaimer on your website to really make sure that that investor is just knocking on the door by his own initiative. Otherwise, yes, you may have a problem, because each time you approach a Lux resident and you are doing a marketing activity, then you are doing a regulated activity in Luxembourg. So that will be a problem, yes.
Barbara, what about in Italy?
I think the same goes true for Italy. We would have the same concerns. I would add that we, unlike Luxembourg, we do not have any private placement regime. So theoretically speaking, let's say the opening of web for the website for the fund will be part of the marketing strategy. So the only way to assess the Italian market, as I was mentioning before, is the reverse solicitation, unless you are benefiting from a EU passport with a EU AFM. So if we are talking about a real reverse solicitation, and I perfectly agree with Connor that it is not a strategy for fundraising. I say the opening of a website probably is not a problem because it's the investors making the first step.
Connor, anything to add, or you're basically on the same page as our colleagues?
On the same page, I would just add that it's a really high-risk strategy to focus on reverse solicitation. Doesn't really work. Some of the jurisdictions, the FCA, have been more facilitative in terms of their interpretation. They've given some guidance around this area, which is helpful, but other jurisdictions haven't. So it's something to be quite wary of, and dare I say, conservative when you look at the trigger, shall we say, in relation to reverse solicitation.
You know, calling it reverse solicitation makes it sound kind of legitimate. But it always reminds me of what my father used to say when you'd bring home a stray dog. Don't name it, because as soon as you do, it's yours, right? So when you call something reverse solicitation, it essentially gives a sense of legitimacy to it, but you have to unpack that, and you have to look at how did the investor find out about this fund, and if they did it through a legitimate means. And is the entity that's promoting the fund complying with their domestic law? So again, in the US, if you have a fund that is a private placement, unless in the US they're doing what's called a 506C, general solicitation in the context of a private placement, then you have violated those rules. On the other hand, if you are doing a private placement in the US and you are also doing a general solicitation generally abroad under Regulation S, which I'm sure all of you have heard about, then from the US perspective, that's a perfectly legitimate offering. But the question then is, as I go in with a public solicitation under Reg S into the EU, that's where I run into problems, because there's no legitimate way to do a Reg S, correct, if you're a US fund, without setting up some other structure to solicit in Europe. Is that right?
Correct.
So how do I set up that structure? Again, the paradigm here we're looking at is a US manager who wants to raise capital in the EU. So I'm going to turn to Luke. Why is Luxembourg the best jurisdiction for us to do that?
Well, that's a good question. I would say to sum up why we are the best, it's just because investors prefer to go to Luxembourg. So that's the reason. And why is the reason actually? I think we have to go back to the last century, because we were the first country in the EU to implement the UCITS directive back in 1988. So it's for more than 30 years of experience in the fund industry. So we are not the first fund center in Europe. We are the second one in the world, just after the US fund center. But another thing, there are more other things, but if you look at the market share, for instance, of the initiators of the funds, you will see that 20% of the share market is coming from the US. So you have a lot of US managers coming to Luxembourg. And many reasons, but one of the reasons is really Luxembourg is for global distribution. So that's really why promoters want to come to Luxembourg to set up the UCITS. And I know we have the IFM passport. So it's really to access the distribution channels. It's very important. We have also a very flexible legal framework. Innovative too, because for instance, a few years ago, we introduced a new type of partnership, really similar to the Cayman partnerships or Delaware partnerships. So we have a toolbox with very different vehicles even for the legal form. So we have partnerships, we have companies, etc. But also from a vehicle point of view, as I said, there is UCITS, but not only UCITS. No, we are also a big center for other types of vehicles. So we have regulated vehicles other than UCITS. And dedicated to specific target investors. So coming back to your question, it depends also which type of investors you want to target. So if you want to target retail investors, obviously you would need a UCITS passport. So we have a full range also of non-regulated funds. And if you appoint, for instance, an IFM in Luxembourg, and maybe other countries in Europe, but you will have also access to the passport. As I said before, the IFM passport sometimes can be extended to retail investors, like in Luxembourg. In the Netherlands too, you have a top-up regime, for instance, when you can get access to the retail investors. So we have a lot of possibilities out of Luxembourg. We have also a lot of DTTs, double treaty tax treaties, which is also important once you want to structure funds to access the Italian market or Spain or even the US. So tax is always important.
Well, so what about that base erosion concern? Does Luxembourg still require a preponderance of residents in a Luxembourg-based fund in order to access their treaty network?
Yeah, that's really a way. Yes, that should be the case. Yes. Mm-hmm.
So I'm looking at slide 5 of the materials, and this is marketing in Luxembourg without a passport. You know, a US AFM complies with the annual report, disclosure to investors, reporting obligations, and acquisition of control of non-listed companies of the directive. And then you have appropriate cooperation arrangement for the purpose of systemic risk. Explain that a little bit. What is in a cooperation arrangement for the purpose of systemic risk oversight? How does that work?
Well, the purpose of that is to ensure that there is a cooperation between the SEC and the CSSF, which is the authority in Luxembourg. So it's really to know exactly what is marketed in Luxembourg, what is, and from which managers, the strategies also of those funds marketed in Luxembourg, to see whether there is a risk. So it's really to assess the strategies of those IEFs, non-EU, managed in Luxembourg.
And so slide 8 is your summary of all the reasons why Luxembourg is the premier jurisdiction. You mentioned the
I forgot weather also. You know, it's like in Dublin, so it's another argument. Yeah.
Absolutely, absolutely. One thing we haven't talked about is cost. So if a U.S. manager wants to set up a Luxembourg fund to passport into Europe on the retail side through a UCITS or through an AIFMD available private fund, what are we looking at in terms of costs?
Cost for setting up the fund, you mean?
Yes, and then ongoing maintenance.
Yeah, I mean, it depends. You have so many market players in Luxembourg, so so many lawyers and so many accountants. So yeah, it's very tough to put a figure there, because you need to set up the fund, the first step. It depends. I mean, how many sub funds you have in the fund. So you have the legal fees for that. So if someone is interested he can call me after the after the. But I mean, you have to pay also the IFN or the ManCo, and that's still more bips on the top. And then you have a depository, you have a fund admin also. So I mean, you will not set up a fund for 10 million US dollar. I mean, it's not worth the game. So I would think the other way, and I think minimum would be 20-25 million, I think, as a minimum as the asset under management, because otherwise you have fixed cost and it doesn't work. Yeah.
Okay, so let's switch gears to Italy. I will confess, Barbara, my Italian on slide 9 is not as good as it should be. So I see the COVID situation in Italy at the moment. Could you translate?
Yeah, for sure, I will do. I just reported some information that I got from the Italian Association for Private Equity, that is IFI. I think, as you know, Italy was the first European country to be hit by the COVID pandemic, and probably the last one to stop the lockdown in May. Probably the numbers that are reported at the top of the slide are not so dramatic as one would have thought probably March. So fundraising shows, let's say, good numbers. Investments also have been made in this month, and in the second quarter of 2020 demonstrate that there are a lot of deals being made, while divestment probably are the transactions that are somehow has reduced their volumes. Second part of the slide is just to say that many of the PE operators that the association have contacted have shown some probably worries about the future, being that they believe that, let's say, a final turnaround and in any case an increase of volumes that they were before the COVID will be available not next year but in 2022. So that is the Italian translation.
So 2022. Wow.
Yeah.
All right. So let's talk about slide 10. Just
Greg, I wanted to come back on just a couple of comments that Luke had made in relation to the benefits of Luxembourg.
We'll get to you, Connor. Don't worry. We're going to get to you.
Oh, right, okay. Great.
We're going to get to you. Absolutely. Absolutely. But I wanted to explore slide 10, if we could, Barbara, where you say that when the AIFMD law, Italy canceled its national private placement regime.
Yeah.
So how does that work if I want to make a private placement in Italy? Is my only choice to do it through an AIFMD?
Yeah, or through a reverse solicitation. Yeah, we don't have a private placement regime that is available for non-EU AIFs managed by non-EU AIFMs. So let's say probably it was not a better choice to be done when transposing the AIFMD, but this is what our regulator decided. So technically speaking, a US fund cannot be marketed in Italy. Even
See,
if,
now in the United States, the absence of law is generally viewed as license to do whatever you want, but I'm only kidding.
not the case here. No, not the case here. No.
All right. So let's use the same framework we did with Luke. Why Italy? Why should we go to Milan and to set up my fund and to access Europe through the south as opposed to through Lux?
Yeah, except for tourism, weather, and beaches. Yeah, let's say probably we are not benefiting from the same fame as Luxembourg or Ireland. So I'm not probably the winner from the beginning in this conversation. But let's say I think there are probably the best way to approach this question is say, how do you want to? Why setting up an Italian fund? Because you want to acquire Italian assets. So, and that is the experience that we have with non-US, non-EU or non-Italian, in any case, investors coming into Italy. They see an opportunistic market. They see transaction that can be made in the real estate, in the credit sector, in the private equity sector. And probably the best way to approach this kind of deal is getting through an Italian AIF, because let's say it assures a tax regime that is really favorable. No tax at fund level, meaning investors are subject to a 26% level of taxation, but I would say probably all institutional non-Italian investors benefit from a total exemption from taxes if they can come from a whitelist country. So probably that is the main reason why having an Italian structure. I would add that also we do not have the general flexibility for Luxembourg, so we don't have many type of AIFs. We have a contractual one that is the Fondo Chiuso and the corporate one that is the SICAF, and both enjoy a certain level of flexibility because they are not subject to authorization by the Bank of Italy.
Okay, that's very helpful. All right, Connor, we're going to turn to Ireland now. So why is Ireland the better jurisdiction in order to create an access point for a US manager either looking to make portfolio investments in European-based investment opportunities, or in order to raise capital through the creation of a UCIT or AIFMD fund? Excuse me, got the acronym backwards. Connor, please.
It's a difficult question for US managers, and I think they have to go through a bottom-up analysis. So what are the factors that they need to take into account? Well, aside from what the sentiment might be that maybe investors want to go to Luxembourg, I think the questions that they should be asking are more granular. When you look at, for example, the issue of costs, you're not going to have the same cost framework in Ireland versus Luxembourg versus Italy. You're going to have to prepare an annual budget. So what is the cost of the AIFM plus the depository, the administrator, the auditors, etc.? It's not going to work out the same for each jurisdiction, but homework will identify which is the preferred jurisdiction on the basis of cost alone. When you look at the fiscal environment as well, you're looking at different set of considerations. You're looking at the fact that the laws in each member state of the European Union are not harmonized. So therefore, if you're looking to take a strategy that might invest in, let's say, only Italian government bonds or only Italian assets, then the question might be, where is the double taxation treaty network? What is its coverage? And will you get a preferential rate in terms of accessing the DTA through Ireland or Luxembourg? And that's a very focused analysis that has to be done if you're looking at regional investment within the EU. You're also looking at centres of excellence and whether the jurisdiction involved can actually accommodate your strategy. And here you're looking at whether the fund can be satisfied, can operate in terms of all of the complexity that you want to build into the vehicle. So Ireland and Luxembourg undoubtedly are centres of excellence, but Ireland is the leading domicile for ETFs, and they hold over 42% of the European share of ETFs currently in the marketplace. We're also the world's largest hedge fund administration centre. We service over 40% of hedge funds worldwide, whether that be European, Delaware or Cayman funds. And it's not surprising on that foot, therefore, that we are the leading hedge fund domicile within the EU. It is fair to say, when you look at a different asset class such as private equity, again, Luxembourg has the lead in relation to that asset class. We're looking to address that, but it is something to bear in mind as well. And also we've got a very compelling offering in relation to money market funds as well, and also the UCITS framework. So there are some of the issues to look at from a bottom-up perspective, and some of the softer factors come into play as well. When you look at setting up an investment firm in Ireland, again, you're talking about a very low corporate tax rate, 12.5%. And then there's some of the other issues which relates to matters such as flexibility. The central bank has been a flexible and pragmatic regulator. This is illustrated by initiatives that they have developed over the years, such as the first European regulatory authority to develop a specific regime for loan origination funds, and also was the first regulator in Europe as well to implement the Alternative Investment Fund Manager Directive. Aside from that, Ireland is an English-speaking jurisdiction. We will be, following Brexit, the only common law jurisdiction within the EU. And Ireland has got great connectivity for US managers. So if you're flying out of Boston or New York, you can arrive in Dublin in around 6 hours. So it makes life a little bit easier. And then the entire ecosystem surrounding that as well is that Ireland has over 1.5 million workers, and therefore, and it's got in comparison to other European jurisdictions, the youngest population in Europe. So then that facilitates asset managers who need to set up and develop scale or operations in Ireland. So I think there are some of the reasons why, when you look at it in a very focused way, you'll see that there's a lot of issues to grapple with.
All right, so I'm going to thank you very much, Connor. It's very, very helpful. What I'm going to do is put out a hypothetical, and I'd like each of you to comment on a structure that you would recommend in this particular fact pattern. So we have a U.S. manager that has raised a private equity fund, and has already raised $75 million US, and needs to raise another $75 million in order to essentially execute on the strategy. Now, these are private equity investments. These are not publicly traded securities. These are all private equity investments. And they need to raise, as I said, $75 million. They'd like to go to Europe and use a simple structure, as simple as possible, in order to get European investors to invest in this private equity fund. If need be, they'll set up a Cayman feeder, but they really, or a Lux feeder, or an Italian feeder, or an Irish feeder, whatever you guys tell them that they need to do. So I'm going to open the doors to you, Barbara. How would you recommend that this investor proceed in order to, or this manager rather, proceed in order to raise his $75 million?
From Europe.
From Europe, yes.
Yeah. Definitely, I think they will need the UAFM to make the fundraising for them. So let's say we all know that we are used to the third-party AFM. We call that is someone that offers services and asset management services that is already authorized by a competent regulator and the AFMD. I would not say that probably Italy is the best way to have a third-party AFM, because the Bank of Italy has a quite narrow view on what is, let's say, for them a letterbox entity. If you may remember, AFMD essentially provides that, let's say, an AFM does not qualify as such if at least the majority of the functions are given to a third party. In the interpretation of the Bank of Italy, let's say, this requirement has to be considered also for the investment activities. So they are not fine with an AFM having an advisor, investment advisor, or let's say a CIC regulated entity to be the investment manager delegated for all the investment functions. Probably I would guess that the answer is to have a third-party FM that is based elsewhere. Probably Luxembourg, I would say, is the choice that we are seeing as the most popular between our clients. But Italian products could be, let's say, a good question, a good answer to their needs, if at least let's say, part of the strategy, investment strategy, will focus on Italy.
Connor.
Off the bat, rule out reverse inquiry. It's not possible, I think, to get 75 million in terms of capital raising through a reverse inquiry strategy. Look in a very focused way in relation to Article 42. So what this means is you're not developing anything. You're looking to see whether it's feasible to register the US fund in the main capital markets that you're looking at. You're looking primarily at the UK, Italy, France, and Germany, okay? And if you're satisfied that that will give you enough traction in terms of marketing the fund, then that is the line of least resistance, okay? It's not the gold standard. For very active capital raising, which comes with its own cost, in relation to setting up a European fund, then your choices are Ireland or Luxembourg, okay? Each of them are effective jurisdictions. From an Irish perspective, what we would say is that if you set up an ICAV, which is a corporate vehicle, it goes through a regulatory approval process, which is overnight, and that's a vehicle then which would have a European manager and can be marketed throughout the EU, and it would be an effective vehicle. The main benefit of getting, let's say, the European passport and the European, let's say, regulatory approval is that it'll open your fund and your US strategy to institutional investors in Europe. This might be European pension funds, or it might be European insurance companies that are limited to the extent that they might be able to raise capital and allocate to a Delaware fund. So that would be the
Connor, you said something that piqued my interest. You said we'd have to have a European manager. How does that dovetail with the fact that this is a U.S. investment strategy and I have a U.S. portfolio manager who obviously is picking the investments?
Yeah, I mean, it's a European fund manager, so the European fund manager has a lot of regulatory responsibilities, but because it's not going to manage the portfolio management, it would appoint the US manager under a form of delegation arrangement. So under that delegation arrangement, which is permitted within the context of AIFMD, the US manager would still carry out the day-to-day responsibilities of deciding what investments to acquire and to sell on a day-to-day basis.
Now, is the structure you're suggesting a parallel investment vehicle where we have the European fund and the US fund parallel investing in the portfolio? Or are you suggesting the European fund would pour over into the domestic US entity?
I think a parallel fund, I mean, one of the issues with master feeder structures, no matter where you set them up, if you're setting up a European feeder that feeds into, let's say, a US master fund, then you get into the question of the marketability of that fund from a European perspective. In other words, you lose the European passport because AIFMD doesn't allow you to use a feeder fund for the promotion effectively of a master vehicle that could be set up in an unregulated jurisdiction or a non-EU jurisdiction.
That is a very important point for our listeners, excuse me, got the securities mind going here, but our listeners to appreciate that the structure that Connor just identified on my fact pattern is talking about parallel funds as opposed to a feeder fund, because you want to make sure that the passport still works. Connor, that was great. Luke, what are your thoughts? How would you structure?
Yeah, I would go the other way with a typical structure, actually having a feeder in the Delaware, feeding a master in Lux, and putting a feeder in Lux for the US, for the EU investors. And then you have an IFM, as Connor said. You do not need a regulated vehicle in Luxembourg. You can have what we call the RAI for an unregulated fund, but you need to appoint an IFM, and then you get access to the passport for the Lux feeder raising. So I think that's really not the usual, but it's quite frequent to structure it like that. So you have the US feeder feeding the Luxembourg master. And as Connor said, we have a back delegation from the IFM to the US SEC regulated advisor.
So there you have it, 3 very different ways to structure, the same type of investment that we were looking for, with each of the countries offering a different perspective on how to raise that capital.
Yeah, that's true, but we have also parallel funds in the US with parallel funds in Luxembourg. I mean, that's also a way to do it. So it really depends how you want to structure the pooling of the assets and where you want to have that. But yeah, we can do the parallel funds in Luxembourg for sure.
So we have received a few questions, and I'd like to pose them to our audience, or our speakers rather. The first question is, what if you have an open website in the US under Rule 506C, but you state on the website that the fund is open only to US investors? Then a non-US investor calls and asks if you have a fund available for non-US investors, which in fact you do. If you say yes, does that work as a reverse solicitation? So again, I'll repeat the question. You have an open website, a 506C, limited to US investors. However, a non-US investor calls and asks if you have a fund available for non-US investors, which in fact you happen to do. And you say yes, does that work as a reverse solicitation? Moral theology, this would be called the principle of double effect. So, Barbara, does this work in Italy?
But I would say yes, probably, let's say, probably stronger if that specific non-US investors has already invested in one of the funds of the US manager. So let's say if it is realistic to state that they knew about the new initiative. So probably, as it has been said before, it's really a factual circumstances that we are going to scrutinize, to assess if it is a good reverse solicitation or not. And let's say, I would guess that probably having the same numbers of a certain level of investors, or institutional investors, or investor already clients of that manager would have.
Luke.
Yeah, I think that should work. Obviously, provided you do not provide them with a subscription form of the funds you have in Luxembourg. We have also clear guidance from DCSSF about reverse solicitation and pre-marketing. So that's clear that should work here. Mm-hmm.
And how about you, Connor?
No, I take the same view. It doesn't appear to me that there has been any marketing or promotion at the initiative of the AIFM in those circumstances. So I would agree with that. Yeah.
Yeah, I mean, before 506C, we used to tell our clients, become a registered advisor, promote your strategy through open websites, because as a registered advisor, you can do that. And then when the client calls and says, oh, I want to invest, you say, well, my minimum for a separately managed account is $100 million. And they say, oh, well, I'm only investing $1 million. And say, well, I have this fund, right? And so you've gotten the word out legitimately, but you know, you set a minimum, and once they can't meet the minimum, you essentially act like any other good salesman, and you have other opportunities available. Again, principle of moral theology there. We have another question. How about pre-marketing to institutional investors? And let's talk about your individual jurisdictions, and then the question also focuses on Switzerland. And I don't know if any of you are admitted in Swiss or feel like you would offer an opinion on that, but pre-marketing to institutional investors, allowed, not allowed, what are the parameters? Luke? Allowed,
yes. Again, the bottom up there is not to provide any documents that could allow the institutional to subscribe or to commit to subscribe. So you can explain broadly the strategy you have for the former funds you set up. You can even provide them with a draft of the PPM, draft of the LPA. So that's the load, and we can go far in providing documents. There's some flexibility here.
Any comments on Switzerland? I mean, it's okay if you don't. Yeah, it's okay if you don't know. Connor, thoughts?
No, I would agree with that. Again, we're talking about an activity that doesn't constitute, let's say, marketing. So where then is the dividing line between pre-marketing on the one hand versus active marketing? And that's the difficult one to come to grips with. Thankfully, there's a European directive and a European regulation which will be effective across Europe from August 21, so whatever we say, 9 months' time. And that's going to clarify the landscape an awful lot in relation to what constitutes pre-marketing, in other words, not triggering in and tripping into the category of marketing. And it is, as Luke has described, it's a documentation that is not tantamount to an offer. It's documentation that is less than a prospectus, that doesn't provide sufficient information for an investor to make an informed assessment and would not constitute a contractual offer. So in that context, it might mean an abbreviation, a document that could be a sales document, which would give details as to the strategy, but not go so far enough as to be an offering memorandum.
So we have about 30 seconds. Barbara, your thoughts?
Yeah, the same goes true for Italy. Let's say I would add that let's say no subscription form at all, that they cannot be shared for sure, but probably also the documents that allow the investor to complete its investment decision. So it's important that these are not shared before the marketing is permitted.
Well, I hope our audience has enjoyed this very lively discussion about which jurisdiction is better, yours or mine. I thank my panelists, Luke, Barbara, and Connor, for your attention and your participation. And I will, at this point, turn it back to Yvonne.
Thank you, Greg. Yeah, really, really interesting. And I love the back and forth between all of the panelists. And with that, we conclude today's webinar. Big thank you to our panelists for sharing your insights. And thank you to our audience for joining us for today's program. And a quick reminder, we make a list of the attendees of the event available after the fact. And each one of you will get an email with a list. And if you are a member and you would like to connect to any of the other participants, we will be happy to facilitate that. Thank you and enjoy the rest of your day.